Hello guys, greeting from Jakarta. Right after I published the video relating to how to calculate cost of debt, now I will continue with how to calculate the cost of equity. As already mentioned in my previous video, the reason that we need to calculate the cost of equity is because the company use equity as one of their capital resources. So now how we would do the calculation. Let's take a look in my example. I already prepared a short review for how to calculate the cost of equity. So in this video, we will talk about the original version, how to calculate the cost of equity. Let me put the theory, namely capital asset pricing model, or known as CAPM. So the component to calculate the cost of equity is actually the first is risk-free rate. You can come up the value of risk-free rate by using the government bond rate. Okay, just make sure that the period for this government bond rate is actually within the period of your valuation. So for example, if we want to value a stock or maybe an investment which require 5 years economic period, then you need to identify the kind of the government bond which has the period more than 5 years. So along your period of investment, just make sure that this period is within the period of the government bond rate. So let me put an example here. For example, in Indonesia, the last government bond published in around the end of October this year is 4.797%. Okay, so now that is the first component. The second component is beta. Beta is actually representing the systematic rates, and it is pretty easy to identify the value of beta, especially for the public company. All you have to do is join the Google or Yahoo Finance. You can come to the website for Yahoo Finance and put the ticker or the company codes. Right after that, you will find how much beta that they have. Okay. For example, let me put the beta for 0.8. Now let's talk about the written markup. That is the third component for this one. So the written markup is actually the discrepancy between the opening index and the closing index. Okay, so for example, I put the opening index around early of January, and I justify the end of October as the closing index. So for example, in Indonesia, we have at least 11% for this one, the written markup. So now, how to calculate the cost of equity? So cost of equity is actually the same as what we call expected return, like this. Okay, sorry. Okay, the expected return is actually having this formula: risk-free rate plus beta multiply by return markup minus risk-free rate. So the number for the risk-free rate here is actually the same as what we have here. So by using this this component, we may come into this calculation. Risk-free rate plus open bracket beta multiply by return markup minus risk-free rate. Put your close bracket. Okay, and now just put it in percentage and increase your decimal. Ta-da! So this is the way we calculate the cost of equity. Pretty simple, right? But please don't forget to put the right number for risk-free rate, beta, and also return markup. Because the way we justify these three numbers will result in our cost of equity. Okay? Thank you very much, guys, for stand by in my video, and please have yourself to take a look at my other video, especially when we talk about the cost of capital, or maybe weighted average cost of capital, or maybe cost of debt. Stay tuned, stay healthy, and stay happy. Thank you. Bye bye.